My name is Andrew Stotts of the Valuation Masterclass, and today we are going to have a debate. This particular debate is on a company called Fastenal. Fastenal is a fascinating company. This is two students of the Valuation Masterclass Bootcamp who have worked intensely on this company, and one of them has a buy recommendation or a positive view, and one of them would have, therefore, a sell recommendation or a negative view. And today we're going to have a debate. So let me introduce you to the company, Fastenal. This is the one we're debating, and I'll just go through a few points so you understand the company. It's an American company headquartered in Winona, Minnesota, and one of the largest industrial and construction supply distributors in the world. It operates more than 3,000 in-market locations across 25 countries, provides fasteners, tools, safety products, and industrial supplies. Seems kind of like an average business, right? Well, it's Fastenal's biggest mode is that it's embedded distribution model, meaning on-site locations, vending machines, and supply chain partnerships that lock in long-term customers. What a dream. I mean, any company would dream of that. So let's look at that in a little bit more detail. One second. I'm going to pull up the next slide to look at. Now, here's the share price. We can see since August of 2024, it's got strong upward momentum, and the share price has just been a long-term performer. But it looks a little stretched on the momentum, so it'll be interesting to hear the buy side and why that momentum may just continue. And let's look at consensus estimates. Here we can see that there's 16 analysts covering the company, and 11 of those analysts have a hold recommendation. So recommendation is about a hold, and analysts say about 14% downside. They think that revenue is going to accelerate a bit in 2026, but then come down a bit in 2027, and net margin is going to stay roughly the same. I mean, it's increasing a bit in 2025, 2026, and 2027. What about tariffs and all of that? I thought that would really have an impact, but there's not much impact put into those consensus. This is our world-class benchmarking scorecard that shows an incredible and impressive performance. This company is 100% world-class for the past 5 years, driven mainly by strong asset efficiency and also great expense control. There's only a small number of companies like this that are tremendously world-class. Now, let's take a look at Fastenal on my global stock tracker. You can get this stock tracker. I send it out to myself and other people on the list every Monday, and you just scan the QR code, and we've got about 500 companies in this, and I'm looking at the capital goods sector, the industrial sector, and then capital goods sub-industry, and we can see Fastenal down at the bottom. Let's zoom in on that and see a little bit more about that. Here we can see Fastenal's got a market cap of about 60 billion US dollars. Average daily turnover is very high at 114 million. Net margin 15%, ROA 25, incredible, right? PE is expensive at 48, and price to book is at 15 times. We do see positive earnings momentum and positive price momentum, and risk is very low in the sense that it's a net cash company and the beta is close to 1. So let me introduce our debaters. This is Tana Chot, and he is a financial professional with expertise in equity and ETF trading, private fund management, and financial analysis. And he's held roles at Bualong Securities, Tech Globe, Toyota, also Halliburton, and is currently general manager at LE Fluid Chemical, overseeing financial and operational strategy. And then there's Lee. And Lee holds a strong finance and compliance credentials with active CFA and ACAMS membership. His passion lies in combining financial expertise with leadership. He's built a 13-year UK banking career at Bank of Scotland, Deutsche Bank, and UBS before leading Coco Garden Resort in Thailand for 18 years. Ladies and gentlemen, the rules of the debate. We have opening arguments. Each participant gets 3 minutes to present their case, and each side in the rebuttal round has 3 minutes to counter the opponent's arguments. And the Q&A session is for 6 minutes, and that's from me and the live audience. And then we have closing statements where participants get 3 minutes to summarize their position. So, ladies and gentlemen, I want to know from you, are you ready to get it on? Well, I think it's time. So I look forward to this debate, and let the games begin. I'm going to bring the contestants into the arena. And there is Tanachot, and there is Lee. Welcome to the showdown.
Thank you very much.
Hi.
And yeah, we had a good breakdown on the company. So anybody that doesn't know the company, they now have a basic understanding of it. And so let's just look at this for a second. We're going to have the opening statements, and then we'll have the rebuttal round. Now, in the opening statements, you get 3 minutes. And what I'm going to do is just leave us all in here. And then I'll give you, I'll just tell you when time's up. So just go for 3 minutes, and then I'll tell you, I got my stopwatch right here. And so now the question is, Tanachot, are you ready to go?
First? Yeah, let's get it going.
Okay, so we are ready. The debate is going to start. You start your arguments, and I will start the clock.
Okay, hi everyone. I have a bio on Fastenal, and here are the reasons why. So when we think about Fastenal, right, we would think about a traditional and standard cyclical industrial supply company, but this view misses the bigger picture. I want you to view Fastenal as the best-in-class leader that's undergoing a high-margin digital transformation on their product lineup. And they also have a very strong competitive moat, as well as having the wave of American reindustrialization to boost them up for the upcoming years as well. So let's talk about the first point, which is reindustrialization in America. So everyone knows that we have had the first trade war, we have COVID, now we are having another trade war. Companies around the world are working on ways to secure their supply chain, either to move their supply chain closer to their production site, or to have different sources that would avoid the taxation and stuff, right? So for America, we have companies like Apple, GE Aerospace, and Ford, as well as other big European players who are having plans and are currently working on investing in US. And this boosts Fastenal directly on its industrial sales, but we also have a, let's say, non-residential market that I think will be also boosting Fastenal sales as well when the reindustrialization hits. So I projected 8.5% revenue for the upcoming 3 to 5 years. I think this will be very positive and sustain Fastenal growth. The second one is the high margin transformation, right? So the flagship product line is the smart items, the embedded items that they sell, vending machines on site, supply chain management. This contributed 61% right now of total sales. Back 2 years ago, it was about 50 something percent only. So the management has also been very direct on their terminal plan for this lineup of their products. They say it would eventually reach 85%. And this serves as a high margin. I know they leverage this by reducing the SG&A operational costs. This would sustain their operation margin to 21 something percent. I think this is really positive for them if they can reach the 85% terminal value of the total sales for this kind of products. And
all right, time's up.
Okay.
So that's 3 minutes. Good presentation. You talked about the reindustrialization. You talked about the high margin transformation, and management's goal of getting to 85%. They've already gone from 50 to 60 for these higher margin products.
Right.
So, and your revenue forecast is about 8.5% for the next 3 to 5 years, which is strong for a large company like that that's already doing very well. So excellent. That gives us a good foundation. I think we're going to now turn it over to Lee and have Lee tell us what he thinks.
Okay. Hi, good evening. My name is Lee, and I'm grateful to be here to defend my sell recommendation on Fastenal. After 6 intense weeks of research and number crunching, I have derived a target price of $35 for Fastenal. So this implies a 27% downside from the current price of $48. Using a DCF valuation and a weighted average cost of capital at 8.6, a terminal growth rate of 3%. So I believe that these are all very fair assumptions. We have close to 70% of Wall Street analysts recommending a hold. The mean target price is $41. This already indicates a downside of 14% from current levels. My analysis, however, suggests that this is even a little bit too optimistic. So Fastenal stock has appreciated 36% over the last 6 months and is now trading in premium territory. It's having posted an all-time high of $50 just last week. So FOMO, momentum, is well and truly in play. We witnessed similar price runs in 23 and 24, both of which ended up in full or very deep retracements. And as the saying goes, what goes up must come down. So without getting carried away in a wave of quarterly optimism, my argument for a sell recommendation is rooted in 3 core stories. First off, Fastenal has been unable to achieve its key new on-site growth targets. The ISM manufacturing PMI has been in contraction for 10 of the past 12 months. In fact, the data for August was released just yesterday with a headline PMI of 48.7, confirming yet again that the US manufacturing is still in contraction. In 2024, Fastenal missed its on-site new contract targets, reaching only 358 out of the targeted 375 to 400. This shortfall is even more pronounced in 2025, with an estimated 160 signings as of the second quarter. This is tracking at just 86% of its mid-year prorated target. The second point is Fastenal's on-site strategy and evolving product mix are shifting it towards a lower margin business. Its gross profit margin has been steadily declining at a CAGR of 1% over the last 3 years, and I forecast this to decline by a further 1% to 43% by 2029. This is due to large national and on-site accounts demanding better pricing concessions, combined with a dilutive shift in product mix towards lower margin safety supplies. The share of the higher margin fastener category has actually declined 4% since 2022. And lastly, intensifying competition. Competition is intensifying and increased capex is needed to maintain its position. Rivals like WW Grainger are upgrading their keep stock, their own on-site model, and directly competing for large contracts, whilst Amazon Business poses a threat with its razor-thin margins for the smaller transactions. Now, Fastenal is in no means a bad company. In fact, it has some exceptional attributes. If you're looking to add to the stock, that's great. All I ask is that you consider my valuation. Perhaps you could buy this in 6 months at a much cheaper price, allowing yourself to enjoy the upside rather than the pain of the drawdown.
Great. Okay, so now we've got that sell argument coming from Lee, talking about first, share price is up 36% in the last 6 months. Do we want to be buying now? The second one that is counter to, Tanachot's, part of Tanachot's argument is, hey, they're missing growth targets and the U.S. economy is in contraction. So how can they be doing better over time? Also, the discussion about the on-site shift, pushing them into lower margin products, as well as customers that are bigger and more powerful. And then you mentioned about intensifying competition, which, on the one hand, you could argue that makes sense. You talked about Grainger, you talked about Amazon. But on the other hand, you could say, well, they've been having competition coming at them for a long time, And so I think we've now got a layout of the arguments on both sides. So next we're going to move into the rebuttal round. And this rebuttal round is where each of you will get 3 minutes to present your counters to these. So in the rebuttal round, each side has 3 minutes to counter the opponent's arguments. And so what we'll do is we'll turn it back over to Tanachot, and why don't you kick it off? I'll start the timer as soon as you start going.
Okay, in response to Lee's story for slow growth, I think it's a matter of viewing the short-term concerns vs 3 to 5 years runway for growth. Lee mentioned ISM, right? It's a leading indicator for like 2 or 3 quarters ahead. I mean, look at Fastenal. It has always been under pressure for its cyclical nature, and yet the stock price also hold itself and also risen recently as well. So I think the market and people who are buying, they see the value, that they can see value past the few quarters ahead. And I really anticipate the reindustrialization, the upcoming of data center building to really boost up another market spot for the non-residential MRO product lineup for them as well. And for competition, I think Granger is a main competitor, right, in the industrial space. But if I were to bet on one company, I would bet on a first mover, which is Fastenal, and also a stronger one at management. That's the reason why Fastenal also had like 45% gross margin and then a very strong operational margin as well. So I bet on the first mover and the strong management team. I don't think that can be copied easily. And for Amazon, I think they are in a different space. Those who buy online, they are not really the bread and butter of Fastenal, but they are the other market that Fastenal has yet to capture as well. It's a DIY home residential market and also small to middle market size. It aims at the small and middle size market. So it's I don't think it's really a threat for Fastenal right now, not especially the ones that Fastenal has already gotten their hands on.
And what just one thing is, Lee, you're talking about expanding margin. Lee's talking about falling margin. How do you reconcile that?
The falling margin is from the products, from MRO products that they're not doing the OEM by themselves, right? But this is a very minimal fall in margin in the top line. I see they can leverage its operation from its digital transformation that I just said to offset this for the upcoming years, and they
Okay.
can manage that.
Okay, great. So now let's shift over to Lee. Lee, you got 3 minutes for your rebuttal. I'm going to start the clock as soon as you start speaking.
Okay, well, thank you to Tanachot. I appreciate his optimistic picture of the US reindustrialization, which is bold, seeing as the US manufacturing sentiment remains continuously negative and PMI is in contraction. This weakness has even continued into August, as confirmed by yesterday's data release. This isn't just sentiment, it's impacting Fastenal's core business. The company missed its new on-site contract target in 24 and is tracking even further behind in 2025. Furthermore, Fastenal has cut its installation forecast for fast vend and fast bin devices by 11% for the remainder of 2025 due to the soft demand. If reindustrialization were truly a significant growth driver, would Fastenal be consistently missing these crucial targets and reducing internal forecasts? While Fastenal's digital footprint is expanding, it's a minimal increase. It was 60.4% in 24 and now is up to 61% in the second quarter 25. I don't think that the growth translates to the bottom line benefits predicted. The company itself lowered its 2025 digital footprint sales goal from 66 to 68%, now down to 63 to 64%. stating that this is due to lower volume through our FMI devices due to weaker business activity. So even digital adoption is vulnerable to market weakness. The projection of an operating margin reaching 21% by 2029 seems too challenging to me. Fastenal's operating margin actually declined 1% to 20% in 2024. Additionally, Fastenal expects elevated IT spending in 2025 to address delayed projects and improve distribution. This suggests that the digital footprint is not retaining SG&A, but rather it can attract significant and ongoing outlays. I personally would not expect an expansion margin. It's also interesting to note that the SG&A expenses actually grew faster than net sales in 2024, increasing at 3.6%, whilst net sales grew by 2.7%. And finally, yes, it's true that Fastenal may have been first mover in the on-site solutions, but the idea of a long-lasting moat against competition is kind of outdated. The competition is intensifying. The rivals like WW Grainger, they're rolling out upgrades to their own keep stock on-site model, and they have direct competition for the large accounts. Amazon Business is a beast that could easily attack the lower value transactions. Even Fastenal's CEO acknowledged the need to improve its e-commerce operations during the second quarter 25 earnings call, specifically stating that there is a need to fight the competition. So competitive demand, substantial investment to merely stay relevant, not to mention growth. Fastenal's capex increased by 33% in 24 to $214 million, and guidance has been given to allocate up to $270 million in 2025.
Okay, time's up. Okay, excellent. All right, so we've now completed the rebuttal round, and we're going to now move into the Q&A round where you in the audience and myself can ask questions. So I'm going to go to the chat to see what kind of questions that we got. I see some questions in here. So let me just see. Hold on. So one of the questions from DP is Fastenal's distribution model a real moat or just efficient operation? If you recall, Michael Porter says that just being efficient at execution isn't a competitive strength or a competitive advantage. That's debatable, but I'm just curious your answers to this. Either one of you can answer that, or both of you can answer that. Go ahead.
I have a view on this. So Fastenal will remain the top player for the fastener because they have a lot of brick and mortar stores that expands throughout US. This is a very like low value product, right? It sometimes it's in the cents per piece, and they can't simply do that in scale without the distribution center and its current brick and mortar stores are acting as a very efficient ways to leverage on that and make them still the top players in this area. So I think it's a moat.
Okay. Let's another one is coming from DP also. If Fastenal has delivered consistent growth and strong returns over multiple cycles, what makes this the point in time where the upside's gone?
Well, the upside, as in, if we're talking about price, how much more upside do we really have when we've just been hitting all-time highs? As far as like revenue upside, there is upside still there. I'm forecasting 6%. The analysts out there are forecasting 9% for this year. I've lost my train of thought there.
Yeah,
gone.
That's okay. That's okay. So we're just talking about the cycles, right? Yeah. And come on, it can survive this. It's not that, So that's one thing. And if you want to add anything to that, Tanachote, feel free. Otherwise, we'll move on to the next one. Okay, let's go to the next one. So Can pricing power and vendor managed inventory system truly protect margins if industry demand weakens? And I would like to add to this because, you know, if demand is weakening, let's just imagine what Lee is saying is right. It's already weakening now, and it's going to continue to be weak. And you have to have some exposure, to the market. Wouldn't the best player, the highest margin player, be the one that you want to own during that time?
For me, pricing power definitely comes into play when things are rough. They have more room to negotiate with the supplying side and as well as customer side. Also, Fastenal is a net cash company, right? Also, they're used to having a long account receivable from their customer. They can extend that or leverage that, play around with that to sort of retain customer or get new ones when times are rough. I think this is what a company with a net cash and storage of resources can do when times are rough. They can play the pricing war as well.
I mean, they definitely have more room with the margin. Let's look at a question from Roman, and I'm going to add in a little bit on it too. It says, how would Fastenal differentiate its competitive offering from competitors such as Grainger and Home Depot to be in a better position to take advantage of the U.S. industrial boom? Before we answer that, I want to piggyback on what Roman's asking. And, here we've got Lee saying, hey, economy's already in bad shape. And we got you, Tanachod, saying that we've got a reindustrialization. And I'm just curious for you, Lee, how long do you think this depressed nature of the economy, do you think that that's going to be in the next couple of years and we're not going to get a reindustrialization boom? Or what's your thinking on that?
Okay, so I wouldn't imagine that we're going to enter any sort of major depression, but I do feel that for at least 1 to 2 years that it's still going to struggle. It's still going to be sluggish. The government's got a lot of work to do. So I'm not all doom and gloom, but perhaps we should start seeing some upside in 26, 27 perhaps. But it's we'll have to wait and see. Also need to see once all this tariffs, once everything is in line and becomes in the rearview mirror, we could all probably get a better view on how things could be.
And Tanachod, what is your thought? You're very positive you've talked about Apple, GM, Ford, you're talking about 8.5%. Can you tell us a little bit about what you're thinking there?
Yeah, I don't argue with the upcoming quarters will be hard for Fastenal, but for the reindustrialization plan, when they plan to reinstate a manufacturing site, a new data center, the construction lead time, it takes years. It takes 2-3 years to build, and this is the time that Fastenal would really get sales on this new one non-residential MRO product going up as well. So
is what you're saying that the weakness that we have, that's fine, it just takes time, and then it's going to really accelerate? Or are you saying that the weakness that Lee's talking about is not weakness that Fastenal is feeling right now?
Fastenal is feeling on the industrial side, but on the construction that's being reinstated into the US, I think that can help offset the impact and help retain the sales.
And let's now talk about this differentiation. I would like to talk about Grainger and Home Depot because I think it is an interesting question. One of the things about Fastenal, when I first found the company, I was like, oh my God, this is the most sticky company. Like, how are you going to exit from this company once they're in your, warehouse? And so, yeah, Grainger and Home Depot is going to come along and say, hey, switch to us. But I mean, that's a brutal process. So I'm just curious, either the differentiation or just the power of stickiness, how do you think that the competition is going to play out over the next, let's say, 3 to 5 years with these two competitors?
Yeah, it is interesting. Same as you, when I first heard about the Fastenal model, I thought it was fantastic, and still do. It's great, but Grainger, they've fully adopted it now. They have the tools. They're in companies. They're on site, so they're borrowing the same model. Fastenal would need to stay relevant and need to. I don't see there's anything exceptional about Fastenal's delivery compared to, say, Grainger, for example. They're now working on a similar structure. So they need to think about what can we do just to be that little bit extra. And at the moment, I'm not seeing it.
And just to get an understanding,
Yeah.
when you're talking about Grainger, do you guys have any idea as to how threatening they are right now? Like, if Fastenal has X number of customers that they're in-house on, Grainger has Y. Do you have any indication as to where Grainger is in that process?
I know that Grainger's revenue is substantially higher than Fastenal's. The market cap is similar. I actually don't have numbers on their accounts. I did look, but it wasn't published, or at least what I could see.
And Tanachot, have you seen any numbers on that or no?
I looked at Grainger is bigger, but Fastenal has better operational edge, right? And I also looked at the keep stock. It hasn't been pronounced up until like 3-4 years ago, compared to Fastenal, who has their own like trucking fleet, as well as a lot of stores across US. I think they move first and they can move fast right now. If they want to speed up the distribution or signings across US, they will move faster, I think.
So I just want to try to get a final reconciliation of the growth figure. You guys have both talked about your angle. What is an investor supposed to think now? Is it something in between the two of you, or do you really think that one of you is just way too pessimistic or way too optimistic?
Certainly, yeah, I can't argue that the stock price is high right now, but
I'm talking about the growth in the economy, like the reindustrialization. I would say the perspective from Lee is like, come on, it's not there, it's weak, and so I'm just curious, like, how do you reconcile that?
I would say that really it probably is somewhere in between the two. We're obviously trying to make a point on a debate as well, but things are rough, there's no doubt, but there is potential, there is hope on the horizon. So we all hope for a recovery. Okay,
so part of what you're saying is it's bad now, and maybe it'll come back up. It's going to come back up, but it's not like going to be on fire.
It's not going to be on fire. No, I don't think so.
Whereas Tanachot is pretty convinced that we have the potential for the reindustrialization that could be a further acceleration that the market's not yet put in. Okay. And we have another one that's interesting. We've actually gone over the time for Q&A because I think this is such a great story, and I appreciate learning from the two of you. This one is about international expansion. Sometimes you look at a company and you think, oh, there's no more growth, and then you realize, oh my God, I missed the fact that they could grow 10x from where they are if they go, really serious international. How do you guys, each of you, just take a short amount of time to answer the question, what's your stand on international growth?
I believe this is something they should really consider. They have a small presence already, nothing major. It's an opportunity for them. I'm surprised that they haven't really made any sort of strong announcements or ideas or support of this. It's a great idea.
Okay. And Tanachot?
I think they would plan to scale on on their playing field first in the hometown US,
Mm.
because the infrastructure, the brick and mortar stores, the trucking fleet, they're all there already, and they see that they can scale up from there for the market that they have not captured yet. But scaling to the global would be, they would eventually come to the global stage, because all of the products they are built or shipped from outside of the US, right? So I don't think it would be harder than harder to have it in Europe per se than in the US. I think
Okay.
the supply chain would be similar.
Okay. Excellent. So now we're going to go into closing arguments and take a moment. We're going to start with Tanachot on this, and I think it's been an interesting debate so far, with both sides coming out strong. Tanachot, are you ready to wrap it up?
Yeah. So we know that Fastenal is a cyclical company, right? And usually they don't do well on the first and fourth quarter because it's winter. But that's a story that we have to compare year to year. And but when we see Fastenal, I want you to see for a longer picture, up to the 3 to 5 years. And that I really believe that the reindustrialization, the data center, the consumption of power, right? Data center, they this would be the main driver for the new markets for Fastenal as well. And that uh, I want the audience to bet on a company that has good management, has a strong track record of strong management. That's why they have 45% gross margin and 20% operating margin. That cannot be copied easily, even if you have companies with same product. They can simply have that level of operational excellence in over a short period. So I think that's the mode, and it's unique for Fastenal.
Great. All right. So, Lee, what about yourself?
So, in conclusion, I would say I still stand by my sell recommendation on Fastenal. I believe that a $35 price target could well be hit within the next 6 to 9 months. The core of my argument is rooted in the fundamental shift and pressure that will impact Fastenal's future profitability and growth. I've observed a clear slowdown in new contract acquisition and significant cuts to installment forecasts and other internal growth metrics due to persistent weak manufacturing environment. It's directly impacting revenue streams. It signifies a structural challenge. For the year 2025, I forecast revenue growth of 6%, which is still very admirable, yet this is placed 3% below the consensus forecast of 9%, which I just cannot see. I believe the analysts are just too optimistic. The company's strategy towards on-site solutions and embracing a greater mix of non-fastener products is inherently leading to gross margin compression. It's a trend that I forecast to continue to result in a decline of gross profit margin to say 43% by 2029. And finally, the intensifying competitive landscape necessitates increased capex, particularly in e-commerce and distribution center upgrades, which will further pressure profitability and cash flow. I expect that capex will grow at a CAGR of 9% through to 2029. So despite its past strengths and potential for broader industry tailwinds like reshoring, Fastenal's current valuation multiples, to me, indicate that the stock is significantly overvalued. While the broader capital goods industry may benefit from trends like reshoring and AI, Fastenal's specific strategic choices mean it's unlikely to fully capitalize on these opportunities for margin expansion unless there's a significant strategic shift. I believe the consensus are overly optimistic and will likely need to be downgraded as these realities become more apparent. Investors should recognize these structural challenges and the current overvaluation. Therefore, I reiterate my sell recommendation for Fastenal, and I appreciate Tanachot and thank you for his input.
Excellent. Well, exciting. You got some comments from Momin who said, well done. Madura also said, well done to both of you. And also DP said, powerful views from both sides. But I just want to give some feedback that, I appreciated both of your arguments. And it's hard, it's, as we can see with any stock, it's never certain, because if it was certain, it would be in the price, completely, and we could never really make money. And really what you've demonstrated is that when we think about a stock like this stock, it comes down to a few key points, and only time will tell. On the one hand, there's a political argument that America's going to go through reshoring, and you can also say that there's an economic argument. I mean, look at the collapse in exports from China to the U.S. I mean, who's going to make those goods? And, in theory, if Trump was really on the ball with this, he would set, manufacturing on fire, lower interest rates, very low, and incentivize people to start new businesses, incentivize engineers, and, all that. And that could fire it up. Or it just could be that exactly what you've pointed out, Lee, that, things are weak and they're not going to get that much better. Why is the Fed going to lower interest rates? They're going to lower interest rates because the economy is bad, and it's going to fire up the stock market, sure, but is it going to fire up the reindustrialization? I think you can also make, having spent some time in China in the past, I was like, oh, the engineering and the hub of knowledge is so powerful in China, and you realize 30, 40, 50 years of declining education in America, there's a consequence. You can't rebuild that engineering base just, overnight. So, there's just so many things. I think it's also, it's the idea of the margin is a hard one also for us. On the one hand, they're just super stable. I mean, it's hard to see them get that margin knocked down. Can they expand it? Whew, that's also hard to, so that one I think is such an interesting one. When one of the things is the shift towards a low margin. Can you just explain that, just for my own benefit to understand? Lee, you talked about the shift. What exactly, for someone that doesn't know Fastenal, how would you describe what's happening there?
Okay, so the
this is just a fun discussion, by the way. We're done with the debate.
Good. So the fastener category that provides its highest margin. That's the best product for it to sell. So it's now shifting to MRO, machine. Not shifting. It's selling more machine repair and operational goods, safety supplies. Such as hats, gloves, etc. So there's less there's less technicality of it, and their supply chains are shorter. It's also an area where they're sort of perhaps underexposed, so they're shifting into that market, I believe, because the fastener market is saturated, but the MRO market there's some room for development there, but they're not getting the same margins on those type of products as they would do on the fasteners.
Okay.
So they're not giving up on fasteners by any means, but they're exploring. They're stocking these vending machines up with general supplies.
Yeah. The other thing, Tanacho, that I kind of agree with you on is the competitive moat. And one of the things that you can argue is that sometimes it's good to get your competitor competing with you in your terrain, in your area, because they're never going to build that mentality that's in their DNA. And so they're just going to spend, and never make the margin that Fastenal's able to make, because it's just in their DNA. And I'm curious from either one of you guys, it's like, is there a possibility that Grainger or Home Depot are going to be pulled into an area where it doesn't fit their DNA and it's not their thing to be on site?
It's quite possible.
I mean, Grainger is very, very similar to Fastenal in many ways. The only edge that Fastenal have is its distributing and supply chain networks in the US that's stronger, I think.
Right.
It's otherwise it's neck to neck, but I think it can work with that strong supply chain.
Yeah. Okay. Well, I just want to say that was great, and you guys both did an excellent job at presenting and defending your points. And I'm really proud to be able to be a part of it and see, this transformation that both of you guys have gone through, to be at a point where you're comfortable up there talking about your opinion. And so, and you understand that valuation is really about your opinion and the stories that support that. So I would say, well done. You guys have anything you want to share before we wrap up?
It's a great experience. Thank you very much.
Yep. Tanachot?
Well, I'm still not comfortable with with sharing though. Actually, I'm kind of like sweating in the air conditioning
Oh yeah,
environment.
so am I.
Yeah.
Yeah.
Well, it's part of getting out of the comfort zone. I think also the other thing that's great is that you guys have set a good example for the other students in the Valuation Masterclass Bootcamp, and also for future students. Like, this is what they got to beat. And that is really exciting for me. So that part, raising the bar, is fantastic. So well done.
Yes.
Thank you.
All right.
And thank you, Andrew.
Yep. I'm going to wrap it up there and take you guys out for a second. I'll bring you back in after I go off. So just hang on for a second. How about that? That was pretty amazing. I really felt like I learned a lot more about Fastenal, and it gave me some things to think about. For instance, is America going to go through a reshoring or not? That's an interesting question that I think, in theory, America should be going through that. Now, also, I thought it was great, that Lee also, he presented the fact that it's a good company, but hey, price is too high. And I think also it was great, that Tanachot was trying to bring us to, hey, come on, don't get overexcited. We got 3 to 5 years of great growth ahead. So yeah, just saying goodbye to everybody. William said, you did a great job, impressive presentation. Yes, they did. And also Superkit says, really nice. Yeah. And Roman says, I learned a lot. Vito says, what an insightful presentation. So I really want to just congratulate both Lee and Tanachot for their great job. If you want to build a competitive advantage in company valuation, join us at